Hi, good evening, everyone. Thanks so much for joining tonight's webinar on software as a service. Over the course of tonight's webinar, I'll be sharing with you some of what I found out about the industry, why it is becoming more popular, why more companies are embracing it, and how do we evaluate companies within the industry. Okay, so without further ado, we will start tonight's webinar on software as a service. It might be something that is new to you because there might not be something that you have looked at previously. What we want to be doing tonight is to go through the software as a service industry, be able to educate everyone around some of the key developments in the industry and how do we identify investment opportunities in this sector. Okay, my name is Gerald. I'm the founder of Beansprout. We are a MES licensed financial insights platform, helping you to make better financial decisions. So before I started Beansprout, I was a research analyst. I was looking at Singapore stocks for close to 10 years, started with the oil and gas industry, then moved on to looking at Singapore REITs, Singapore banks. And I think today's session is very special to me because while I've looked at quite a number of sectors within the Singapore market, the software as a service industry is something that I did not have the chance to explore deeper previously. So I spent the last few months trying to read up more about the industry, and I hope to be able to share with the participants tonight some of what I've learned over the past few months. Okay, the usual disclaimer that tonight's sharing is for informational purposes only. While we'll be discussing the software as a service industry, there might be specific stocks that are mentioned. They should not be taken to be financial advice or a solicitation to be buying or selling any specific security. Okay, so quite a number of things that we will go through tonight. I will start with an introduction to the software as a service industry. Thereafter, we'll look at some of the key growth trends within the industry before looking at the key metrics to be evaluating these companies. As investors, we are always looking at interesting opportunities and we want to find companies that are attractively valued. So I will share a bit more about how to value SaaS companies as well. And last but not least, all investments come with risk. So I will share some of the risks relating to this industry as well. Okay, so we'll start with a brief introduction to software as a service. Maybe before I start, I just want to do a quick poll amongst all our participants who have joined us tonight. If you have previously heard of software as a service, put yes in the chat. If you have not, put a no in the chat. Okay, I see some responses. Calvin has heard of it. Jimmy, quite a number of you have maybe heard of software as a service. It might be new to some of the participants who have joined us tonight. But whether you are new to this or is something that you know quite a bit about, what we want to do is to identify what this industry really is about and how we can identify investment opportunities from there. Okay, so I always use this example to be able to explain what software as a service is. I think we can use a very real-world example to be able to help us understand. So I'm sure many of you use Microsoft Office. Not sure what is the average age profile of the participants who have joined us tonight, but when I was in school, I actually have to buy the CD-ROM and install it on my computer to be able to use the Microsoft Office suite. Okay, so it might be something new for some of the younger participants who have joined us tonight. But in the past, like Calvin mentioned in the 90s, this was really how software was sold. It came in the form of a CD-ROM, which I then had to install on my computer. But coming to this day and age, if I want to be subscribing to a software such as Microsoft Office, effectively this is something that can be done online. And I actually sign up for a subscription with them, whether is it on a basic plan, personal plan, or a family plan. Okay, so I think this is probably the best way that we can see how software has actually transformed over the years And what we see today is effectively what we call software as a service. It is no longer sold to us in a CD-ROM, but actually based on a subscription kind of method for us to be able to access this software more easily. Okay, so in a nutshell, software as a service allows users like you and me to be able to access the applications through the internet on a subscription basis. In the past, when I think about a license model, say buying the old Microsoft Office prior to Office 365, these software licenses were sold either in a floppy disk for those who remember what it is, or CD-ROM for those who remember what it is. And these are meant to be installed on individual devices. Okay, so this is effectively the old way where software was sold. If they launch a new model of the software, you have to go to maybe 𝗕𝗵𝗲𝗀𝗀𝗃𝗀 to be able to buy the latest CD-ROM and to install this on your computer. So the key characteristic here is you would have to pay an upfront cost for a one-time license. This is through the purchase of the floppy disk or the CD-ROM. You own the software for a specified time, or it can be until there is a new release that you want to be upgrading towards. And you would then also be responsible for some of the updates as well as maintenance. Okay, if we then fast forward to this day and age, for a software as a service model, I don't have to go down to 𝗕𝗵𝗲𝗀𝗃𝗀𝗃 to be buying this floppy disk or CD-ROM anymore. Effectively, I can download the software from the internet. The fees are charged to me either on a monthly or annual basis over the subscription term. And that really comes to the term software as a service. Okay, so this software can be hosted on cloud such that anyone who has internet connection can access the software. And by accessing this software, we actually have to pay a recurring fee, and the manager of the software, which may be Microsoft, would be the one responsible for providing the updates, for maintaining it, as well as ensuring that the security is there. Okay, so in this case, there might not be any significant upfront cost, but what we pay instead is this recurring fee to be able to access the software. Okay, so that is how I would roughly summarize what is the difference between a perpetual license model and a software as a service model. And I hope that actually provides everyone with a rough understanding around what this model really is. Okay, so earlier I used Microsoft as an example. It is probably one of the best examples I managed to find for a global tech company that transited from selling software licenses to offering software as a service-based services. Okay, so the Microsoft Office suite would probably be a good example. The other example that is commonly used is Adobe. So in the past, again, if you're using Adobe Photoshop, so you actually have to buy this software in the form of a CD-ROM. Now it is actually sold to us in a software as a service format, where I subscribe to the Creative Suite and pay a recurring subscription fee. Okay, so I'm sure you can think of a lot more examples apart from Microsoft and Adobe. And I want to just maybe get everyone to think a bit more about other examples that we might see in our day-to-day lives. Okay, so can you maybe try to suggest what are some of the other software as a service companies that we might actually see on a day-to-day basis? Okay, Kelvin, thanks so much for your answer. Zoom, yes, so this webinar is held on Zoom. Zoom actually didn't have a previous model where it was sold on a CD-ROM basis. Effectively, because it is a relatively new company, when they started, it was already based on a subscription-based model. Okay, so during the COVID-19 pandemic, when all of us were working from home, that was really when Zoom became very popular, and the software as a service model grew significantly because you don't have to go down to the physical shop during the COVID period to be buying the Zoom software. With a download on the internet, all of us can still communicate with our friends, our co-workers, through the Zoom software that is sold on a subscription basis. Okay, so some of the other examples shared by other participants. Workday, Microsoft Teams, yes, Apple iCloud, SAP. Yeah, so those are effectively different software that are now based on a subscription basis. I see some suggestions around Spotify and Netflix. So Spotify and Netflix are subscription-based models, but in this case, effectively what it does is to enable people to be able to access video online through Netflix or audio online through Spotify. So while it is based on a subscription model, if I go with the very strict definition of software as a service, then maybe it might not fall directly within this category. Okay, but it is still based on a subscription model, just that effectively it is not exactly selling you the software, but the content that is available on this software. Okay, so here I have a list of some of the largest software as a service companies globally. I think some of you have actually highlighted some of these names. So Microsoft with its application suite is actually the most well-known software as a service company and also the largest. Okay, for those of you who are in the sales or marketing business, you probably would know of Salesforce, which is a customer relationship manager software that is used very frequently. I mentioned Adobe earlier, so that is used by a lot of the designers for their creative work. Someone also mentioned SAP, so that is an enterprise management software. Zoom that was mentioned by Kelvin earlier and what we are using tonight. So quite a number of different software that are now on this model. And what we see here is that they are actually fairly big. Microsoft close to 245 billion worth of revenue. Salesforce 36.5 billion of revenue. And even Adobe has got 20 billion of revenue. So this has actually become a very significant industry as companies evolve from selling their software in the form of a CD-ROM towards selling it on a subscription basis. Okay, so these are the broad categories that I will group the different companies into. One of the largest categories would be customer relationship management. So companies in this category would include Salesforce, HubSpot, Microsoft, some of their software would be in this category, as well as Adobe. Okay, we have some of the enterprise resource planning companies, SAP and Oracle. We have some of the HR management software like Workday that was mentioned earlier, collaboration and productivity tools, things like your Microsoft Teams and Zoom. And last but not least, your marketing automation, such as MailChimp, which is a software that my team also uses to send out our weekly newsletter. Okay, so what we see here is that these are the largest subsegments within the software as a service industry. And in terms of the growth rate, most of them are seeing fairly healthy growth rates of double digits in recent years. So you might be wondering, oh, why do companies actually want to transit from selling a CD-ROM towards a subscription-based service? To me, it actually brings a few key advantages. First and foremost, it allows the company to be able to earn a stable and predictable revenue. Okay, so in the past, when it was being sold as a CD-ROM, they may not be able to predict when customers are going to be upgrading their software or when they might actually then decide to switch over to a competitor's software. But when it is based on a subscription model, they can effectively have a better prediction around what the revenue that comes through from the subscription is going to be. Okay, with that, there are more sales opportunities and hence potentially bring higher business value. So they can effectively try to get you to subscribe to a higher value of products and services. They might find other things that you might need and would be subscribing towards. So all of this bring additional sales opportunities for the company. Last but not least, because the software is accessed online, there can be different analytics done around what services you are using more frequently. So for example, as a subscriber of Zoom, how often do I use the software? Do I use more of the webinar or meeting function? How many people typically join my meetings or webinars? So those are things that the software company can then analyze to better understand what they can develop to serve their customers better. So because of these advantages, quite a number of the internet companies, a lot of the tech companies have moved towards the SaaS model, as we have seen over the past few years. Okay, so before we move on to the next segment, just a quick quiz. What are the advantages of the software as a service model? I hope you can join me in trying to answer this question. 1, stable and predictable revenue. 2, more sales opportunities. 3, better understanding of customers. And 4, all of the above. Okay, so I see quite a number of responses coming in. Most of you have answered 4. So that is all of the above, which is the correct answer. So it shows that so far you have been listening to what I have shared. And those are really the key advantages of the SaaS model in that it allows the company to earn a more stable and predictable revenue, creates greater sales opportunities, and allows them to develop a better understanding of the customers. Okay, so since most of you managed to get this question right, I assume that my pace is okay. You have been able to get a understanding around what software as a service is so far. Okay, so with the understanding of software as a service, we are next going to understand what are some of the key trends around the industry growth. Okay, so what was very interesting to me when I was doing my research is really how big this industry has become. So in 2024, we saw that the industry, in terms of the revenue across all the companies, was actually close to $400 billion US dollars. Okay, so in 2024 alone, we saw the industry growing at close to 20%. And that is actually a fairly strong pace of growth to me. Why do I think it is a fast pace of growth? If I look at, say, Singapore's GDP growth, last year we grew at 4%. The US economy also grew at low single digit. So with a pace of growth that is at double digit, in fact, close to 20%, it actually shows that it is growing at a faster pace compared to most other industries. Okay, but I think as investors, we also need to look ahead. Is this pace of growth expected to continue? Is it expected to slow down? And based on the forecast by some of the consultants, it is expected to continue growing at about 12% per year and then surpassing 800 billion worth of revenue by 2030. Okay, so that is the global software as a service industry. Sitting in Singapore, we are also interested to understand the pace of growth in the Asian market. So currently, the largest software as a service market globally is in the US. Okay, understandably, given the very large population size. But what we also see is that the APAC software as a service market is also growing at a very fast pace, 22.5% in 2024, representing about 86.4 billion of revenue. And that is expected to continuing to grow at 15%, reaching 200 billion by 2030. Okay, what is interesting to me from this chart is that earlier, if you recall my previous chart, the global SaaS industry is expected to grow by about 12% over the next few years. And if I look at the APAC number, expected to grow at 15%, which tells me that the APAC SaaS industry is expected to grow at a faster pace compared to the global average. So with that, you probably wonder, oh, how does that relate to us? Do we have any examples around how it may potentially benefit the Singapore economy? So I went to look for some of the examples. So currently, we see that the bulk of the SaaS companies are based in the US, okay? But there are more and more of the software as a service companies that are also emerging in Southeast Asia, in Latin America as well as the Middle East. And this presents additional growth opportunities for the SaaS companies globally. Okay, so some of the recent news that I managed to find just this month, Salesforce announced that it is intending to invest 1 billion in Singapore over the next 5 years because it believes that it can grow its customer base as well as partner ecosystem in the region. Another company that I saw was 𝗕𝗄𝗰𝗃𝗀𝗃. They launched their new 100 million international R&D hub in Singapore about 3 years ago. So that will continue to deepen the base of the company in Singapore. Okay, so while we are looking at some of these companies from a consumer perspective, we also see that some of these companies are investing in Singapore and helping to create jobs in different areas. Okay, so if I were to look at some of the fastest growing subsegments within the SaaS industry, what is actually having the most significant growth would be AI-powered SaaS. Given how much AI has become a buzzword in the past year, how it is now being increasingly used by not just consumers, but businesses as well. AI-powered SaaS is becoming one of the areas that is having significant growth. The next area is data analytics as well as business intelligence. So as more and more data is being created, so for example, from tonight's webinar, there is data that's going to be created from the recording. There's going to be data being created from what I'm going to share. And these are things that different businesses can use. And as more and more of this data gets generated, some of these software tools might be useful for us to be able to analyze the data as well. Okay, the other areas, I mentioned some of them earlier, collaboration and productivity tools, things like your Zoom, they are considered a collaboration tool. So that is also one of the fast growing SaaS category as companies and individuals look at different ways that they can boost their productivity. Last but not least, marketing automation. I mentioned 𝗵𝗲𝗰𝗹𝘂𝗀𝗋 earlier, amongst other software that can be used by companies like Beansprout to be able to make our marketing efforts more productive as well as efficient. Okay, so one of the areas that I shared was having fairly significant growth would be the use of AI within the SaaS industry. I think for many of us, we are starting to use ChatGPT in some of our work or for personal reasons. And likewise, companies are also exploring how AI can be used to be able to make their work more productive. So this is a research done by consultant McKinsey. And what they find is that amongst companies that have applied AI in their work, effectively, they have seen an increase in their recurring revenue, and the customers also see a faster pace of growth. The other key area that's come up together with the growth in the SaaS industry is really the need for security. I think many of us are aware of the risk of cyber attacks. We are all afraid of potential scams. So security is definitely top of the mind for both users as well as providers of the software. And what we have seen as a trend is that businesses are investing heavily in security enhancement to be able to ward off some of these cyber threats. Okay, so I have actually mentioned two of the trends within the SaaS sector. One of it is AI, one of it is security. And I think those are evident in terms of how they are actually growing fairly strongly and becoming more and more of a trend within the industry. Okay, so just a quick quiz for this segment. Which SaaS segment is expected to be fastest growing? One, collaboration and productivity tools. Two, AI-powered SaaS solution. Three, marketing automation. Four, data analytics. Okay, this one is a bit harder than the previous question. Hopefully you have heard what I've shared previously. and would be able to pick out which of the subsegments is actually growing at the fastest pace. Okay, so the answer is two AI-powered SaaS solution. And I think these are all the different subsegments that are growing very fast. Data analytics is growing fairly quickly as well. But I think if I were to look at all the different subsegments, then it is really the AI-powered SaaS solution that has seen the most fastest pace of growth. Okay, so having had an overview around what software as a service is, having looked at some of the key industry trends, now we are going to do the work of a financial analyst and look at what are some of the key metrics that we can use to evaluate SaaS companies. Okay, so I think for most of us here, we are investors in the stock market. We are looking at potential investment opportunities. We are not looking to set up a SaaS company. So I think what we really want to do is look at what are the different metrics that we can use to identify which is a company that is doing better compared to the other. Okay, so before we go into that, we can take a look at how the different companies generate their revenue. Okay, so there are a few different monetization models, some of which might be familiar to you if you are a subscriber to this different software. Okay, so the most commonly used one is a subscription-based pricing strategy. I mentioned Microsoft quite a bit during today's webinar. So in this case, if you are buying the Microsoft Office subscription, you'll be paying monthly or annually. And this will ensure a steady revenue stream for Microsoft. Okay, next it can be a freemium model. And I think for those of you who use Zoom, you might be familiar with this freemium model. So previously, when I was just communicating with my friends during COVID, it was just the four of us catching up during the COVID-19 pandemic. We were just using the free plan where effectively after 40 minutes we'll be cut off, but it's okay because all of us can just join the webinar once again. Okay, but as we started to go back to work, and for me myself, when I had to organize tonight's webinar, I can no longer use the free plan because I'm sure you don't want to be cut off after 40 minutes and having to join this webinar once again. Okay, so that is where I had to subscribe to the premium feature and paying more for my subscription as a result. Okay, so that is the freemium model. Effectively, what the software company does is it provides a free service for you to test out the software, but then they try to get you to subscribe to higher value plans. Okay, the last one is usage-based, probably something that is more prevalent in the enterprise space compared to the consumer space, where the customers are charged based on their actual usage. Whether is it that if I use more of the cloud storage, then I have to be paying more, or if I'm actually getting more data from the software, then I have to be paying more as a result. Okay, so that is a usage-based pricing strategy that we see for some of the companies such as Twilio and Snowflake. Okay, so this is the part where we will start to take out our secondary school or even a higher level mathematics and understand what are some of the key metrics that we can use to identify the better SaaS company. Okay, so you might be wondering what is a good metric that we can use to evaluate these companies. If my friend actually recommends me a SaaS stock, how do I know that it is a good company rather than just buying it blindly based on my friend's recommendation or a broker recommendation? Okay, so the key metric that I would be tracking is this metric called annual recurring revenue. Okay, if there's one key takeaway that we can all have from tonight's webinar, remember this term, annual recurring revenue, because it is the key to evaluating SaaS companies. Okay, so you might be wondering what annual recurring revenue is. Effectively, it measures the predictable revenue a SaaS company earns from its subscriptions over a year. Okay, so this would include the revenue of its yearly subscription. It will include the add-on and upgrades, and it will take away some of the revenue loss that is due to downgrades, cancellations, or churn of the customer. So why is this annual recurring revenue important? For the company, it offers a very clear and reliable projection of the future revenue. So long as it's able to keep its customers, maintain its sales growth, then this annual recurring revenue would then form its revenue in the coming years. Okay, so once the annual recurring revenue is there, it gives us an idea of the company's stability and what is the potential growth for this company, for investors, as well as various stakeholders. With the revenue visibility, the company can also better allocate resources, so whether to employ more workers in a particular area, such that the use of resources is more efficient as a result. Okay, so you might be wondering, how is this annual recurring revenue being calculated? So I have an example here. This is the part that I mentioned. You might actually have to take out your calculator to be able to go through this calculation with me. Okay, so I have an example of a SaaS company here. The revenue can come through from a few different areas. One would be the subscription, which we have put it as $50 in this example. The term license and support might be $20 and the maintenance might be $10. Okay, there are also other services that might be charged to the customer, such as the software installation, and we put this as $20. Okay, so if I'm trying to calculate the annual recurring revenue, how much would that be? Effectively, what I'll do here would be to add the subscription revenue, the $50. I'll add in the term license revenue, the $20, the maintenance revenue, which is $10, and all of it will give me an annual recurring revenue of $80. Okay, the reason why I add these three components together is because they are more recurring in nature. So subscription is recurring, the term license and support is recurring, maintenance, you can actually expect that the customer will require some form of maintenance through the course of the year. So that is something that can be recurring as well. The services component here is more, say, for the installation. So for example, this is not software, but I use something that we can all relate to better. So if I am trying to, say, subscribe to broadband internet, so that is on a subscription basis that I pay on a monthly basis. But when I initially subscribe to my broadband internet, the provider has to come down to my house to install the necessary equipment. So that can be considered a service revenue because they're providing you a service to install the broadband internet. So because it is a one-time installation, they are not going to your house to install the equipment every year, which is why it is then not considered as an annual recurring revenue. So likewise, when the companies are selling their software, when they are helping the customers to provide some of these services, which might include installation, it might not actually be seen as something that is recurring in nature. Okay, so we have the annual recurring revenue here at $80. Okay, so then the next question is, how do we determine the quality of its revenue? So this is where another metric, which is called the recurring revenue mix, becomes something that we can look at to understand the quality of the company's revenue. What this effectively measures is the percentage of revenue that are subscription-based as a percentage of its total revenue. How is it being used? The higher the recurring revenue, the larger and more consistent the company's revenue stream is going to be. Okay, so this is a good thing because we want the company to have higher quality revenue, revenue that is recurring, revenue that is consistent, as well as predictable. Okay, so going back to the previous example, how can we then calculate the recurring revenue mix? So the total revenue here is $100. We shared that the annual recurring revenue is $80. So for this one, hopefully you don't have to take out your calculator. we can calculate the recurring revenue mix to be 80%, which is taking the recurring revenue of $80 divided by the total revenue of $100. Okay, so we want this to be as high as possible. If it can go up to 90%, even better. But if the recurring revenue mix is effectively just 40%, 50%, then that might mean that the company is not able to earn a lot of subscription-based revenue. A big part of its revenue is still coming through from one-off sale of product or services. And that might mean that the company might not be seen as being such a good SaaS company. If you want to understand whether the company that we are analyzing has got a good recurring revenue mix, we can actually compare that to the industry benchmarks. So earlier I mentioned that the calculation brought us to a recurring revenue mix number of 80%. So this happens to be in line with the industry average. What we see here is that for the publicly listed SaaS companies, the average recurring revenue mix is 80%. It can go down to about 66% for companies that have a lower recurring revenue mix. And for companies that are doing very well in terms of having sustainable revenue, it can go up to close to 89%. So we have looked at the annual recurring revenue. We have looked at the recurring revenue mix. The other key metric that I'll be keeping a very close lookout for is the retention rate. Okay, so what this retention rate tells us is whether the SaaS company is able to keep its customers over time. The better the company is able to keep its customer, I think that can be a representation around the level of customer satisfaction. It is a reflection of the service quality as well as the long-term health of the business. Okay, so this is where the calculation gets a bit more complicated. I want to introduce this term that is called the gross retention rate, which measures the ability of the company to retain its existing customers. Okay, so we have the annual recurring revenue. Earlier, we saw that it was at $80. But what we are going to take away from the annual recurring revenue is the downgrade ARR, which is the decrease in revenue because customers are downgrading in their plans for the subscription. Okay, so that leads to a lower revenue for the SaaS company. Next, we also take away the churn ARR, which is the revenue loss due to customer cancellations. Okay, so when we take away the downgrade ARR and the churn ARR, we are able to calculate the gross revenue retention rate. Okay, so I have an example here to be able to show how we can calculate the gross revenue retention rate. We saw the ARR was at $80 earlier. We take away $6, which is the downgrade ARR, from customers who decide to switch to a cheaper subscription. Okay, we also take away the churn ARR, which are the customers who decide to stop using the software. So $80 minus $6 minus $4 gets us to $70. And divided by the initial ARR, we get to a gross retention rate of 87.5%. There is also another measure of the retention rate, which is called the net retention rate. And here we also include the ability of the company to be able to expand with existing customers. Okay, so earlier we took away the downgrade ARR, we took away the churn ARR, but what we want to also be adding back as part of the net retention rate calculation is the ability of the company to get higher revenue from upselling to existing customers, cross-selling to them, and adding on additional services. Okay, so this is called the net expansion revenue. And by adding that to the gross retention rate, we are able to get the net retention rate. Okay, so here we have a worked example of the net retention rate. And what we are going to do is to add in the expansion from existing customers as well. So earlier we have the ARR at $80. we take away $6 from customers who are downgrading to a lower subscription. We take away $4 from customers who decide to stop subscribing. But what we are going to do as part of our net revenue retention rate calculation is to add in the customers who are subscribing to maybe higher price plans, and that is the net expansion revenue for this company. So in this case, we're adding an additional $20 from customers who are going to be generating a higher revenue for us to the $80. We continue to take away the $6 from downgrade ARR and $4 from churn ARR and divide that by the initial ARR of $80. So with that, we get to a net revenue retention rate of 112.5%. So hopefully that is something that you're also able to calculate using this formula. So having done the calculation of the gross retention rate as well as the net retention rate, the key question that we might have is, how do we know whether that is a good or bad number? So we can compare that against the industry benchmark. And here I've put up two numbers, one for enterprise-focused SaaS companies and one for small and medium businesses, focused SaaS companies. What you might have noticed here is that the gross retention rate is higher for the enterprise-focused SaaS companies compared to the small and medium business-focused SaaS companies. Why is that the case? Because if they are enterprise-focused, their customers are typically the larger companies, and these companies have a lower likelihood of going into bankruptcy or potentially canceling on their subscriptions. Okay, so the benchmark gross retention rate for enterprise-focused SaaS companies is 87%, and for small and medium business-focused SaaS companies, it is at 72%. Next, we look at the net retention rate. Likewise, we have a higher number for the enterprise-focused SaaS companies at 110% versus the SMB-focused SaaS companies at 101%. Okay, there's one final metric that I wanted to just briefly mention about, and that is the lifetime value versus the customer acquisition cost. So typically, the SaaS company will have to spend some money to acquire the customer. This might be in the form of initial marketing expense. It might be in the form of sign-up rewards. And what we want the company to be able to do is earn higher revenue from this customer compared to the cost from acquiring this customer. So for example, if the SaaS company is spending $50 to acquire a customer, we ideally want the SaaS company to make 3 times of this customer acquisition cost in terms of the entire lifespan of this customer. If it is not able to do so, then it will probably find it a struggle to be able to get good financial metrics because it's not able to earn significantly more from this customer versus its customer acquisition cost. Okay, so we have gone through the most difficult part of tonight's webinar, which is the key financial metrics used in evaluating SaaS companies. And I think what is the next point that we want to be thinking about is then how do we value SaaS companies? So before tonight's webinar, I went to look at some of the key metrics. I look at Salesforce, which is one of the largest SaaS companies globally. And when I look at my dashboard, I saw that there were quite a number of different valuation metrics that can be found for Salesforce. Okay, so here we have the price to earnings ratio, we have the price to sales ratio, we have the price to book ratio, and we have this ratio that's called the enterprise value as a percentage of the revenue or EV to revenue multiple. So the question I have is, which multiple should I use in valuing SaaS companies? Okay, should I be using the price to earnings multiple? It might be something that many of us might be familiar with when looking at our Singapore banks, when looking at a manufacturing company. Or should I be using a price to book multiple, which is a multiple that can be used for, say, real estate companies? Or should I be using the enterprise value to sales multiple to be able to evaluate these SaaS companies? Okay, so please put in your option in the chat box and let me know what multiple would you be using. Okay, I see some who indicated that they'll use the price to earnings multiple. Okay, I see some who have indicated the enterprise value to sales multiple as well. So quite a number of different responses that we have here. And I wanted to share that in this case, I'll be using the enterprise value to sales multiple. Why is that the case? When I was looking through various research reports on the SaaS sector, I found that the enterprise value to revenue ratio is actually the most widely used valuation multiple when looking at these companies. So in case this multiple is new to you, effectively what this does is it measures how many times the annual revenue is the company actually worth. For those of you who are familiar with market capitalization and not so clear around what is enterprise value, effectively what this does is it adds the debt level of the company to its market capitalization. So that's how we get to the enterprise value of this particular company. Okay, what we do see is that the price to earnings ratio is less commonly used for SaaS companies. And the key reason is really because a lot of these companies may not be profitable as yet. Okay, so they may be investing for growth. They might still not be able to get sufficient customers to make their business profitable. So in that case, it is difficult to get an earnings number from these SaaS companies. So if we don't have an earnings number, we can't get a PE ratio. And as a result, we have to be using the enterprise value to sales multiple instead. So the question would then be, how do we know what multiple to pay for a SaaS company? Why should one SaaS company trade at a higher multiple compared to other companies? So this is where I wanted to introduce the rule of 40. Earlier, I mentioned that the annual recurring revenue is one of the key metrics that we should understand about SaaS companies. The other key terminology that is really important is this concept called the rule of 40. So what is this rule of 40? It is effectively the sum of the company's revenue growth as well as its profit margin. So what we want is that the sum of the revenue growth and the profit margin should be more than 40%. So if a company has a revenue growth rate of 20%, profit margin of 20%, that will get us to a sum of 40%, and this company would meet the rule of 40. On the other hand, if a company has a revenue growth rate of 10%, profit margin of 10%, then adding these two up would just get us to 20%, which means that the company is still far away from getting to the rule of 40. Okay, why is this metric important? Because this effectively tells us whether the company is able to balance both growth as well as profitability. If a company has got very high revenue growth but not able to get good profit margin, then it is quite unlikely that you'll be able to achieve the rule of 40. On the other hand, if it's got very high profit margin but growth is slowing down, then achieving the rule of 40 might become an issue as well. Okay, so what we want is high growth companies as well as companies that are able to get a good profit margin for the service that it provides. Okay, so what we see here is that companies that are able to achieve the rule of 40 typically trade at a higher EV to sales multiple compared to companies that have yet to reach the rule of 40. So using the January 2025 multiple as an example, we see that companies that have the sum of their revenue growth rate and their profit margin exceeding 40%, trading at an average EV to sales multiple of 11 times. Okay, if I were to compare that to companies that have got a summation that is at between 30 to 40%, then the average multiple for these companies is just at 8 times. If I were to look at companies who have a sum of these two metrics at just 20 to 30%, then they trade at an even lower EV to revenue multiple of just about 5 times. Okay, so what we want to do when looking at potential opportunities in the SaaS sector would be companies that are close to achieving the rule of 40, but potentially trading at a lower valuation multiple compared to the industry benchmark. Okay, so having discussed the valuation of SaaS companies, the last section that I really wanted to cover would be the risk relating to investing in these SaaS companies. Okay, so all investments come with risk, and I think one of the key risks when looking at the sector would be to understand that these SaaS companies are sensitive to economic cycles. Okay, the key reason behind that is that when there is a potential economic slowdown, whether they are the enterprise companies, whether they are small and medium businesses, or potentially even consumers, are likely to cut back on some of their subscriptions, and that can affect the revenue of the SaaS companies. At the same time, because the SaaS companies are high growth businesses, earlier we shared that they might not be profitable, so the valuations are dependent on the future growth expectations. I looked at the share price of Salesforce, and I think this is probably a good illustration around how the share price can potentially be volatile. So if you recall back in 2022, we were in a high inflation environment after coming out of COVID. What the US Federal Reserve had to do was to raise interest rates aggressively to be able to bring down inflation. So as interest rates were being raised, what we saw here is that the share price of Salesforce came down as investors reset their expectations around the valuation of these SaaS companies. Okay, apart from market forces, we also have industry-specific risks to be aware of. One of the key things is really around data breaches as well as potential leakage. So earlier, when looking at some of the key growth drivers, we noted that this need for data security is very important. Okay, so when it is stored in cloud and being held by these software companies, they will need to pay more attention to ensuring that it is secure. Otherwise, if there's going to be any breach, it might lead to potential financial losses, reputational damage, as well as even legal issues. Okay, last but not least is really around the company's ability to be able to be financially stable. So if they're not able to find good customers for their service, if they are not able to sustain their financials, if a lot of their customers are actually churning, then what this means is that they might potentially face financial difficulties, which might then pose an issue towards the valuation of the SaaS company. Okay, so the final quiz for today, what are some of the risks for SaaS companies? The first is data breach, 2, economic cycle, 3, financial sustainability, and 4, all of the above. Okay, so put in your answers to the chat box and we can understand whether we know of the risks relating to these SaaS companies. Okay, so I see quite a number of responses is 4 of the above. I think that represents that we are aware of the risk in investing in these SaaS companies, in that they may face risks relating to data breaches, economic cycles, as well as financial sustainability. And those are some of the key risks I'll be looking out for before investing in these SaaS companies. Okay, so I've gone through my presentation deck. What I want to be doing now is to take your questions. If you've got any questions, do put them into the chat box, or you can also post your questions in the Q&A section of this webinar. Okay, so I will start by answering this question. What is vertical SaaS? So effectively, you might come across the term horizontal SaaS versus vertical SaaS. So what vertical SaaS is effectively there might be software companies that operate within a particular vertical of the industry. So as an example, I might be a software company that is serving the healthcare industry. I can be a software company that is just serving maybe the government sector. So in that case, I'm offering a very niche service within the industry, and I try to identify problems to solve that are specific to this industry. So that is vertical SaaS, where I try to expand within this vertical, which is the industry that I understand the regulations, I know the customer problem, and am able to best identify how I can serve these customers. So this is different from horizontal SaaS, which is when companies actually expand across different industries. So if I'm using, say, a client relationship management software, while I may initially just be serving the healthcare industry, I can use this same software to then serve other industries, even including, say, the government sector. I can serve the tech sector, as my software can be used across many different industries. Okay, so I hope that answers the question on what is vertical SaaS. Okay, I see a next question around the initial cost outlay for SaaS companies. How should investors perceive this in valuation of the SaaS companies? How should efficient growth be quantified? And is it common for horizontal consolidation in the SaaS sector? So quite a number of questions here. I'll take them one by one, starting with the initial cost outlay in the SaaS industry. Okay, so I think that really goes back to what I shared earlier, which is the rule of 40. Okay, because that effectively tells me whether the company is able to balance both the growth as well as their profitability. If their growth is very high because they are just spending a lot of money to acquire customers, they may not actually get a very high profit margin. So in this case, the rule of 40 might not actually be achieved for these SaaS companies. But on the other hand, for companies that may have a slower pace of growth, but able to achieve better profitability as a result, then they are probably going to be closer to achieving the rule of 40. And once they achieve the rule of 40, they are likely to trade at a higher valuation compared to companies that are not actually at this rule of 40 as yet. Okay, so that is how I will see whether companies are able to balance between the initial growth versus their profitability. And that is why efficient growth is something that more and more companies are focusing on, because not only do we want companies that are growing at all costs, but we want them to be able to achieve profitability as well. Okay, is it common for horizontal consolidation in the SaaS sector? It is something that we see more and more often because as the software is able to serve one particular industry, they might find more cross-selling opportunities towards other customers in other industries as well. So that is where horizontal consolidation might take place, where maybe in the past you've got one company that's just serving the healthcare sector. You might be having one company that just serves the government, and they can potentially combine together such that they are able to serve these different sets of customers using the same software. Okay, next question around should SaaS companies eventually be valued based on PE rather than EV to sales, as we want to invest in companies that make money? Okay, so yes, eventually we want companies to be able to make money and hence having an earnings that we can value the company based on. So I think over time, we see that some of these companies can become profitable, in which case we'll value them on a PE basis rather than an EV to sales basis. So for example, if I'm looking at, say, Amazon Cloud, if I'm looking at Apple, they are all profitable companies. In China, we also have Alibaba and Tencent that are profitable tech companies. So as companies continue to grow, as the industry continues to mature, then we can start to look at some of these companies from a PE basis. But because in this case, we might want to compare them still with other companies within the same sector. And in this case, not all companies within the SaaS industry might be profitable as yet, which is why we might still go back to using an EV to sales so that we can then compare them to other companies within the industry. Okay, if there are no further questions, I wanted to do a quick recap around what has been shared today, and those are the key learning points that we can all take away from tonight's webinar. Okay, so first and foremost, we discussed what SaaS is. It allows users to access applications through the internet on a subscription basis. Okay, it brings about potentially more revenue predictability, more cross-selling opportunities, and potentially better customer understanding for the SaaS companies. So these are the key benefits as to why companies want to adopt a SaaS model. We look at some of the industry growth trends, and what we saw here is that the SaaS industry is expected to grow further, particularly in Asia Pacific. Okay, what are some of the key growth drivers for the SaaS industry? Number one, we have got AI that's driving a lot of new software. And then secondly, a greater focus on security, which is also creating new opportunities for the SaaS industry. Next, we took out our calculators. We look at some of the key metrics. I mentioned that the annual recurring revenue is the key metric that we can use to evaluate SaaS companies. And then next, we look at the valuation of the SaaS companies, in which we shared that the EV to sales multiple is the most commonly used multiple when looking at this industry. How do we know whether a company should trade at a higher EV to sales multiple? That is where the rule of 40 comes in. We want the company to achieve revenue growth, have good profitability, and those are the companies that then tend to trade at a higher valuation. Last but not least, all investments come with risk, and we shared some of the risks when investing in this sector, including a potential economic slowdown, cybersecurity risk, as well as financial sustainability. Okay, so that is a summary of what we have discussed tonight. If you want more resources relating to the SaaS sector, we have recently published an industry guide. You can download it from our website, 𝗕𝗲𝗰𝗪𝗀𝗀𝗀𝗀𝗀. It is actually what you will see as the first article that comes out on our website. If you want to continue to engage with Beansprout, to be able to ask us various questions, do get in touch with us through our various social media channels. Okay, so with that, we have come to the end of tonight's webinar. Just as you are leaving, we hope you can help us with a quick survey to help us understand how you find tonight's webinar and what else we can potentially share with you in future webinars. Okay, so thank you so much for joining the webinar tonight. I hope you have been able to gain a better understanding of the SaaS industry and can do further research into this industry as you look at potential investment opportunities in this sector. Thank you, everyone, and have a very good evening. Thank you.